Hey everybody, it's John King. It is Friday, the 10th of December, and here I am with your weekly market update. It is a big start to the new year, and it is not a good start for those who need mortgage rates or want mortgage rates to go lower. A lot of news to cover, a lot of things I want to talk to you about. I've got this screen over here that you're seeing that's flashing red, like red everywhere. Red is bad news, okay? I'll explain to you what's happening over here and walk you through it, but bottom line is that nothing today was good news for mortgage rates, and it is painting a challenging picture for the coming year. So we kind of hoped heading into the end of 2024, things were going to look good, especially around the end of the third quarter in September. We thought everything was rosy, and bam, we have been shot in the foot. We have been about-faced. Mortgage rates are not on a decline, and they are literally at the highest we've seen in over a year. So we are higher rates than we saw at any time in 2024. So what the heck's going on? First of all, the Trump economy is here. We've got 10 more days until he is officially the president. This is not a political statement. It's just factual. Everything we've been talking about since November when Trump was elected was, hey, that's going to be good for the economy. It's going to spur jobs. It's going to spur businesses to spend money, but that's going to create challenges for inflation. And that's exactly what's happening right now. We have the jobs report that comes out the first Friday of every month. That jobs report came out this morning. This isn't the first Friday, but they delay it when there's a holiday or a short amount of time for them to prep it after the end of the month. So jobs report came out this morning. More jobs created than expected, significantly more jobs created than expected. The unemployment rate went down. So we went from 4.2% of the people that want to work that can't find work to 4.1%. You'd think, well, John, that's good news. Like, what the heck is happening? No, it's bad news for mortgage rates because the Fed has two jobs. The Fed's two jobs are to keep inflation low and employment high. So keep as many people employed as we can. You're like, well, John, that's good then. The Fed's doing what they're accomplishing their goal. We've got low inflation and we've got employment that's high. But those two goals compete with one another. And so they're always yinning and yanging, fighting over one versus the other. And so what the Fed is basically doing is the Fed says that we focus on getting inflation down by raising interest rates. But when you raise interest rates, that hurts jobs. And then once inflation's under control and we focus on creating jobs, and to create jobs, you lower interest rates. Well, right now, the Fed is kind of saying, look, the market is handling everything for us. As a matter of fact, inflation is low and jobs are being created at this high interest rate, like the rate that we're at right now. And the Fed says, man, we can kind of take our hands off the wheel because the economy is doing exactly what we want it to do. We're splitting the difference, the soft landing of, hey, we don't have high inflation and we don't have an unemployment problem. We have high employment. Well, that means the Fed doesn't need to lower rates as much. As a matter of fact, there's an argument. There's a couple people who are saying right now, as a matter of fact, I'll share with you right here. So there's some posts that were put out on X today. The first one I actually want to talk about is this one right here. So this guy basically, again, blockbuster jobs report could be bad news. This payroll report smashed expectations, but it's caused the concern about the Fed not lowering interest rates as quickly as we thought. So here's the second problem, though. The second problem is there's indications that inflation is actually going back up, and he talks about it right here. And so he says, look, we're looking at ISM data, which is basically a leading indicator. It's what purchasing managers are paying, and they're paying prices at 22-month highs. In other words, people who are buying goods to create the end product. So the purchasers who are buying lumber to build houses, the purchasers who are buying chips to build computers, they're paying higher and higher prices. They haven't paid prices this high in the last 2 years, 22 months. The last time that they were paying this much money for goods 22 months ago, inflation was over 6%. That's not a good news because this is a leading indicator that the Fed is going to say, hey, we think inflation is actually at risk of going up. The jobs market's fine. Inflation's at risk of going up. If inflation goes up, the Fed has to raise interest rates in order to keep inflation low. So here's what everybody's saying is, look, we think that this is essentially going to mean that the Fed's not going to start lowering interest rates until probably October. So one of the other posts that I saw here, I don't know if this is the one right here. So the Fed is delaying their rate cuts. The Fed has not said that. This is not what the Fed is saying. This is what the market is thinking. That, look, there's no chance right now of the Fed lowering rates anytime in the next 9 months. The first chance the market thinks that the Fed's going to lower rates again is in October. And so previously we had thought that rates we're going to lower in June or July. Now, this is not one person's opinion. There's a market that trades futures of federal funds, of treasury bonds. And so it is trading based upon what it thinks the Fed funds rate is going to be at each month going forward. And so the market is speaking, not one person talking. This is the market speaking that said, look, we don't think the market does not think the Fed's going to drop rates anytime in the next 9 months. Now, you've heard me say over and over again, the Fed doesn't control interest rates and they don't control mortgage rates, but they influence them. And when the Fed starts moving rates down, we try and predict and get ahead of it. But when we think the Fed might stop raising rates or stop dropping, or maybe even go up some, well, then the mortgage market kind of jumps to be on the other side of that trade. And that is literally what's happening right now. So if I go over here, what you're seeing is a huge drop off in the value of a mortgage. So this is what a mortgage is worth to a mortgage company. So when you sign your loan, that loan is at 6.5%, but rates are now at 7%. And so therefore the value of that loan at 6.5% plummeted. Who the heck wants to hold a loan at 6.5% when they could make 7%? So that's what's happening here. The value of mortgages are plummeting. Why? Because the 10-year treasury is skyrocketing. So this is literally the 10-year treasury rate, what the 10-year treasury, and let me make a quick change here to make this a line, to make it easier for you. This is going back a year. The 10-year treasury has been nowhere near where it is. The closest we got was April of 2024 when we were at 4.68. And then we dropped all the way down to 3.59 in September. And now we've just shot way back up and we're at 4.75, highest rates we have seen in over a year. The question is, where do we go from here? Well, that challenge really comes down to looking at the history, because if we look at the history of the 30-year fixed rate mortgage over a similar timeline, what we're seeing is rates actually were higher in April than they are today. So the 10-year treasury, and I should be able to throw this on here to see it side by side. Hopefully you guys find this to be valuable. The 10-year treasury, yep. If you look right here, let's close that. So you look right here, the blue line is 30-year fixed rate mortgages, and they follow the 10-year treasury. And so in April, the 30-year fixed rate mortgage shot up as the 10-year treasury shot up. But right now, the orange line is the 10-year treasury, and we see the orange line shooting up way higher than the 30-year fixed rate mortgage. We're seeing it jump up today. Huge jump today. The average rate is 7.24 today based upon, this is not my company's chart. This is a national chart. So you've got a lot of room for rates to go up, because normally the Fed funds rate jumps up and mortgage rates kind of stay above it. And this is not above or below because they're using like the chart for the Fed funds rate, the 10-year treasuries on the left. So this is like 4.6%. And on the right side, it's 7.3. What you're seeing is what's called the spread. So when do we think mortgage rates have a shot at dropping again? I don't know. What I do know is I think mortgage rates have room to go higher right now because the 10-year treasury has gone up and the mortgage rates have not gone up as much. That means the spread, the difference between the 10-year treasury and the mortgage rate has dropped. That long term is our saving grace. We're hoping that we're going to see less of a bump between the 10-year treasury and mortgage rates. So right now, using just these numbers, mortgage rates are at 7.25%. And the 10-year treasury is at 4.75, which means we're at a 2.5% spread. Versus back here, we had mortgage rates at where were we at here? We were at 7.5 with the 10-year treasury at 4.69. So the spread was bigger before. I know this is a lot, it's in detail, but hopefully this is valuable. And it's really, really important information for me to get out there. So I have one other topic I want to talk about, which is a $10,000 grant that just released, but I wanted to see the questions that have been asked. And so I see SP says, hoping they stay high for 3 to 6 months, so more vouchers will be issued to the wait list. I have a 796 credit score and have been ready for a year. I am with you, buddy. Lenders have been very wrong about rates since 2022. I've been telling my lender they're not cutting rates. Frankly, rates aren't high enough to fight our true inflation numbers. Well, the challenge is, what are you debating is the definition of true inflation? And I think we could probably get into a pretty detailed conversation about that. I'm with you that there's a lot of market forces that people aren't seeing, that aren't apparent. But the bottom line is, inflation itself is simply how much money you're paying today compared to what you paid a year ago. And so some people say, well, true inflation is prices have gone up significantly every single year. And so the true inflation is a lot bigger. But what you have to account for also is increases in pay. And it takes a long time for increases in pay to catch up. In my opinion, we actually are making up for the amount of time during the 2010s when inflation was super low. Pay kept going up, inflation stayed low, and so we became comfortable. I'm just speaking economically, we became comfortable with prices being low relative to our incomes, and we started spending even more, which is part of what's led to the COVID steroid shots that we got with getting injections of stimulus money. And that then led to a lot more spending and a lot more inflation. All right, we got a comment here. The unemployment rate going down and more jobs are getting created. Not a good situation for interest rates. Exactly correct. Like, that's our challenge. Now, again, if this is the new norm, then things will catch up. It's just going to take more time. I don't see the housing market collapsing. There is nothing about the mortgages that are out there that say the homeowners who are in houses right now won't be able to make their payment. That only happened one time in history, and that's because half the mortgages out there were adjustable, and that interest rate shot up significantly and nobody could afford it. We've got a little bit of a challenge right now with some people took out adjustable mortgages in the last few years. Got a little bit of a challenge right now with some people took out temporary buy downs in the last few years. So that's something that is going to come home to roost. We're going to have some of those people that are going to lose their home because that payment's going to bump up, and they were counting on rates being lower. I think I did 4 temporary buy downs in the last 3 years, and that's only because people really wanted them. I'm not a huge fan of it. I think that it's a bigger risk than you should be taking, but it is what it is. And there's certainly an argument that says it was a good idea if rates were going to drop, or if you knew that you were going to get higher income down the road. So I think that what we're dealing with right now is an earthquake of economic events that are just playing against the Fed and what they've been trying to do. I think that the incoming administration ultimately is going to put more pressure on inflation, drive higher inflation numbers in the short term, because a lot of it is also reactionary to tariffs and things like that. But we saw in the first Trump administration that the way he went about the tariff process is really a matter of making it sound a lot worse than it really is. And he didn't drive up inflation the first time, but inflation did go up in anticipation of him delivering on tariffs, and then it came back down some. So we've got a balancing act that's going on. Again, I'm not being political. I'm not telling you my views of whether I agree or disagree with the administration. I'm just telling you straight of what I see historically and what I'm seeing and what I'm reading right now. So I'm happy to answer any questions about any of that, but I do want to go to my last topic, which is a $10,000 grant that we now have access to for closing costs. This is an amazing program. I'll be putting out a video dedicated to this on all of my channels, hopefully today, or definitely by Monday. If you want to get more information on it, reach out to me directly. It is for low to moderate income buyers. You have to be a first-time home buyer. There's some rules about being in an underserved community, but if you meet the criteria, then you get $10,000 literally of free money, literally no repayment required. So if you're a first-time home buyer, you're ready to buy soon because this money is going to run out. There's enough money for, what am I looking at? 50 people in Northern California and 50 people in Southern California to take advantage of this money. That's how they're separating out the money. And so it's a phenomenal program if you meet the criteria. If you do not see the video on my page or you want to find out about it right now, reach out to us, kingteam@johnloneking.com. You can go to johnloneking.com above, and you can find my email address or contact us through the webpage. But ladies and gentlemen, it is definitely, first of all, time for questions, but it's definitely going to be a rocky road. It is going to be, I had a client today who was looking to, they are a Dream for All buyer. They're in contract. They're closing in 12 days. And they were waiting and hoping that rates got better, and they had to pull the trigger today. They asked me if I thought they should wait until Monday. And I said, I'm nervous because almost every time when we have this bad of a jobs report and this much of a reaction the morning of the jobs report, basically the entire rest of the month goes the same direction, and we continue to see negative news that supports what the jobs report showed. And so I am very concerned about January. If you are in contract or you're about to get in contract, lock as soon as you possibly can. That is a general statement. Nobody can predict the future, but historically the patterns have shown it is not a pretty month when the jobs report comes out and we see this big of a reaction. All right, a couple more questions here. All right, so import data says, do you think we are seeing the interest rates right now? Do you think what we are seeing in the interest rates right now is already impacted by the upcoming administration change? 100% sure. That's actually one of my statements. The Trump economy is here. So yes, I 100% think that what we're seeing right now is being impacted by the incoming administration. There's again, I'm not being political. I'm sharing information. There was a couple of articles in the Wall Street Journal that talked about Biden really not doing very much and created a void in the last few months. There's a term called lame duck president that says, look, you have all the power, but you don't have the political power because you're on your way out. And he didn't perform well enough to even stay on the ticket as the nominee for the Democratic Party. And so Trump stepped in. Like, he's stepped in, and he's in the news every day, and Biden's not heard of it all. And so it's the news, and it's part of what Trump does. Again, agree or disagree with it. He talks really strong and then comes in lower. He wrote a book years ago called The Art of the Deal, and he's a negotiator. And as a strong business negotiator, a tactic, agree or disagree with it, is to make it sound like you are being super aggressive, that you're going to ask for everything, so that when you really ask for what you want, it sounds like you're compromising. If you went in and said, hey, boss, I want a raise of $1 an hour, your boss is going to come back and say, how about 50 cents? But you say, boss, I deserve a raise of $5 an hour, and here's why you should give it to me, and I'm going to quit, and I'm taking all my clients with me if you don't give it to me. Well, you might get the $5, but you probably pretty good likelihood you're going to get $2. You only wanted $1. So that's what I feel is happening right now, that we're seeing a lot of economic earthquakes. Why I use that as a title here. We're seeing a lot of economic earthquakes based on reactions to Trump saying, hey, I'm gonna invade Canada and Greenland and Panama. Well, from what I'm reading, some of his prior policy advisors have shared that, well, in his first administration, he said things like that so that he could get something lesser, like, I want cheaper fees for U.S. ships to traverse the Panama Canal. And so if I want that, well, then I should make Panama think that I'm going to take over and take back the canal from them, so that they'll happily compromise to charging us lower fees for ships to traverse the canal, which ultimately will equal lower costs of the goods that come through the canal, which will equal lower inflation, which will equal lower interest rates. But in the short term, everybody's freaking out like, oh my gosh, we're going to war. And it's creating a lot of economic earthquakes. Okay. All right. A couple more questions here. What are the income requirements? It's 120% of the area median income for the $10,000 grant, but it's based on family size. I have a web page. Email me at kingteam@johnloneking.com. I can send you the link to the page. You plug in your county, you plug in your family size. It'll tell you what the income limits are. So kingteam@johnloneking.com. Again, is there a link to the program? I've got all the details. Actually, I'll send you a spreadsheet that you can go through. Just email me and I'll send you the link so you can get the spreadsheet. Someone with low income can be able to afford a house right now, especially in California. I pre-approved a client today that lives in Los Angeles, as a matter of fact. And he and I spoke this morning, first-time home buyer. They are a Dream for All recipient voucher winner. They're looking at, wrong client. Yes, everything's correct about that client. We're talking about low income. I had a client last night that I pre-approved. That's what I was thinking of, that she fits the criteria. She can buy up to a $500,000 home. And you'd say, John, what can I get for $500,000? Well, that's the question in the market that you're in. But for her, she's in the Sacramento area, Central Valley, I should say. She's looking to buy up to $500,000, and she meets the low to moderate income requirements. She's able to be eligible for the $10,000 grant. So it does exist. It is not most people. It is not most people. There's a lot of hoops on this particular program and rules for this program. But if you fit the criteria, it's 10 grand of free money. Like, it's forgiven immediately. There is very little grant money out there. Very, very, very little. This is forgiven immediately. You don't even have to keep the house for a year or 3 years. It's forgiven right away. So phenomenal program. We'll get a video about it sent out hopefully today, if not on Monday. But email me in the meantime, kingteam@johnloanking.com. All right. Does not look like I have any other questions. But if you do have any questions, post them right now. Speak now or forever hold your peace. Ladies and gentlemen, I really appreciate your trust. Please like this video, share it with those that you know, get them to subscribe. I'm looking to help guide as many people as I possibly can, and I appreciate you all allowing me to guide you. So I hope everybody has an absolutely wonderful weekend, and we'll talk to y'all soon. Bye-bye.